If you watched my previous video where I secured 3 apartments in Dubai and saved roughly 900,000 dirhams compared to the market pricing, this is effectively part 2. Because we didn't stop there. Over the past weeks, we've added another 3 units to the portfolio. Actually, 4. Last one was just confirmed yesterday. That now brings us to 7 acquisitions in total. For those who haven't followed this series, we're building a Dubai rental portfolio for a very long-term client and also co-investor alongside me. The original target was approximately 25 to 27 units based on a predefined investment budget and a very specific acquisition strategy. But what surprised me isn't that we found more opportunities. It's that the opportunities are still there despite everything happening in the region, despite all the headlines and all those people waiting on the sidelines. We're still finding sellers willing to transact significantly below the market price. So in this video, I want to continue on those sourcing series and show you what we are seeing on the ground. For those who don't know me, I'm not an agent, I am an investor myself, and I run an investment advisory firm based out of Dubai, and it's called Agora Advisory. That's why I'm going to show you this journey transparently for the love of making such videos, without any bias or desire to sell you anything. If you'll wish to work with my team in the future, feel free to reach out. Otherwise, enjoy the progress of this journey, and I hope you find this information helpful and applicable to your case. And as always, bringing you the unbiased truth in real estate, hit that thumbs up button, subscribe, and let's get into the video. Let's start with where we are in this sourcing round. For those who are new here, this portfolio is being built for a long-term advisory client who has effectively become a co-investor alongside me, not only in the UAE but also outside. The objective hasn't actually changed since day one. We're still not chasing appreciation. That just comes as a very nice bonus if it does. We're also not chasing the new launch, and we're not even looking at the off-plan, at least for this client. And we're definitely not buying because a developer hosted a nice event. So yeah, as you can see, the target is very simple. Acquire ready properties that can realistically achieve 8% net yields. While you might challenge me and say that maybe right now it's a bit more difficult to calculate that, however, I'll tell you how we do that in a second and how we're planning it to work out in the future. Focus on long-term cash flow, build the downside protection in the acquisition price, so actually make that money when you buy, not when you sell. And again, let the appreciation become the bonus, not the main criteria. Because if you get the entry right, everything becomes easier afterwards. The interesting part is that now we're seeing multiple forces coming together at the same time. First, it's summer. It's a slowdown season. Historically, summers were always one of the most quiet seasons in Dubai, but very good for active investors. Second, we're still feeling the after effects for the Middle East escalation. Whether people agree or disagree, it did affect the sentiment, particularly among foreign investors. Third, off-plan pricing has reached levels that simply don't make any sense in most cases. When a ready property is cheaper than waiting for 3 or 4 years delivery, eventually some buyers, and I hope most of the buyers, will start questioning this logic. All of this obviously creates hesitation, but hesitation also creates opportunity. Not everywhere, not in every building or location, but there's enough to actually matter and take action. Now, what we actually bought this time. I'm obviously not going to disclose the exact units or client information, but I can show you the framework and even disclose some specific KPIs and ROIs. 2 of the units that I'm going to discuss in this video are actually very similar. The third one is based on exactly the same concept, is just in a different tower. Both are fully furnished and both were vacant. Both are located in one of those buildings that I really like, and actually I will disclose it for you because I want to be actually as much transparent as possible. It was in Reba Tower by Damak in Business Bay. It has a very long rental history, and I personally owned units in that tower. Both were purchased significantly below the average prices, and to be honest, even below the price that I paid 2 years ago. One was acquired for 950,000 dirhams. At the time of the purchase, comparable units, because we are actually looking at apples to apples comparison, so the same kind of level floors and so on, were trading at around 1.2 million dirhams. And for this specific unit, the latest confirmed transaction was 1.02 million. So we actually undercut it by quite a lot. Considering that that transaction was done many years ago, well, we actually got a better price than even investing 3 years ago. Our expectation is to get it back to an annual rent of 95,000 dirhams once the rental market is stabilized, producing around 83,000 net operating income after all the service charges. In this tower specifically, the service charges are at around 12,000 dirhams, and most units are either 1 bedrooms and some 2 bedrooms. So again, while you might challenge me and say that now the rents have gone down, which I totally agree, and we are looking at maybe first year making it at 80K or slightly higher, just depending on the flexibility with the checks and maybe getting some better, all inclusive costs for the tenant. We'll see, there are different strategies. But when we get it back to that 95K that we're targeting, and that's also based on my own cases that I rented for multiple years before in that exact tower. So I'm literally comparing apples to apples from my own cases to this new acquisitions. This translates to approximately 10% gross yield based on the purchase price and 8.74% net yield. The payback period is about 12.6 years. And again, if you would have done it through a mortgage, most probably you wouldn't be able to get such a good price, because you only pull this kind of prices in those situations where the seller is quite in distress, or they just want cash quickly. Maybe they want to relocate from the country, or maybe they were just affected. The sentiment is there and, they wanted to sell and liquidate quickly. So you wouldn't really be able to do it with a mortgage. But even if you would be do it with cash and then later refinance, you would be looking at significantly higher KPIs just because you can leverage it and just put a smaller down payment and still have the same rental returns. The second example was even more interesting, as the purchase price was 900,000. Again, it's against market comparables at around 1.2 million dirhams, and we're speaking also fully furnished, really high quality and very, very nice views. One was to the canal and one was to Burj Khalifa on the other side. So in this case, same rent assumption of around 95,000 dirhams. Again, based on my own cases, on my own units that I personally rented out in this tower, so I really do think they will get back to that levels. Same service charge profile, around 12,000 per year, but because of the lower acquisition price, the net yield is moving up to 9.22%. Those were the type of numbers that we were looking for and are still continuing to while building this portfolio. Now, this is the part that most people miss. Whenever I show these acquisitions, people immediately focus on the appreciation. I actually spend more time looking at the downside. I want to be, if not realistic, pessimistic when I invest. Let's assume rents don't increase. Let's assume the market goes sideways. Let's assume the sentiment remains weak. Do the numbers still work? Well, in both cases, yes, because the entry price is doing most of the heavy lifting, but also a very, very important part is that we're looking long term. 10 plus years of holding it. So when you look at this long term, effectively anything that could happen, it's only a short term sentiment. The first unit has roughly 200,000 dirhams upside, just looking at the current market value, or even if you say that now the transactions happen slower and there are still discounts and so on, it's still way over 100,000. And in my personal opinion, over 400, maybe 450,000 dirhams compared to the long-term target exit price. The second unit shows exactly the same dynamics, just because the entry price was slightly lower than we're looking at about 500,000. And that's really long term, and that's obviously when the market stabilizes. But again, that doesn't mean it will happen, but it means that you're not relying on perfection, and at least you know that you entered right, you have cash flow right away, and you're not just waiting on those handovers that might get delayed and just might have you with the money stuck forever. And again, you might still find very nice off-plan deals, and I'm actually looking at some as well. I'm just preferring those in Abu Dhabi right now just because the supply is not as huge as in Dubai. But for this specific portfolio building, we are targeting a completely different case. The biggest thing I'm watching isn't just pricing, it's behavior. Developers are becoming more aggressive again, incentives are returning, and broker activity is actually picking up again. Some launches are slowing, but also off-plan mortgages are being introduced. All of those are signals. And usually when the market starts changing the direction, behavior changes before the statistics do. That's what interests me. A lot of people also ask how these opportunities are found. The honest answer is that most of them, they never reach the open market. They come through relationships, constant conversations with agents, and many people that are just in the market selling and buying, knowing specific buildings, and I personally know even specific floors in some of those buildings, and understanding what actually represents the value. If you're looking for support with property investing, portfolio strategy, sourcing opportunities, or even detailed project and area analysis, feel free to visit www.agoraadvisory.com. There you'll find information about our advisory packages, sourcing services, and investment intelligence reports designed to help investors make better informed decisions before committing any capital. So again, if you want to work with us, please do reach out. All the links are in the description below. If you don't, then enjoy this series, and I hope they really bring some value to you. Now, why does units actually matter? The real story isn't just getting one unit or having 6 or 7 units. It's actually in the process. Because if this framework can be repeated consistently, that's where it becomes interesting. One acquisition can be luck, but 6, 7, or even more become a system. And that's exactly what we're trying to build. As of today, we've secured 7 units, but the portfolio continues growing. The savings continue to accumulate, even though they can't be accessed right now. It will give us huge capital upside in the future, just waiting and not timing the market. Most importantly, the rental income continues stacking, which is a very big differentiator versus not only off-plan, but also most of the markets in the world, where you still have capital gains tax to pay, where you have rental income tax to pay. Here in Dubai, you don't. Why the 8% net yield matters? One thing I constantly see in this industry, not just from agents who are speaking about KPIs that are just incorrect, but also investors focusing simply on the gross yields. And it's simply incorrect to get the rental price divided by the price you paid for that unit and call it a rental yield. Personally, I care much about net performance. Actually, that's the only thing I actually care about. Service charges matter a lot. Vacancy also matters. You need to count that in, especially for the first years, and especially in this kind of circumstances where you might have a month or 2 months unrented. Maintenance also matters, and while we do long-term rents where the maintenance is mainly on the tenant, you still have to count that in. And most importantly, real-world performance matters, not just simply what you see on Property Finder, Bayou, but what are the real transactions happening, both for sales but also for rents. If you look in Digsby Interact, if you look in DLD, you can see all this data there and make your own assumptions. That's why our benchmark remains at around 8% net. If the property works purely from its rental performance, then appreciation becomes a bonus rather than a necessity. One thing I strongly believe is that this window opportunity won't be here forever. Eventually, the sentiment would improve, and not only that, we've already seen the peace talks happening and even the signings of the peace agreement happening between US and Iran. Liquidity would return sequentially as well. And most importantly, the buyers would return, or even the local buyers, the residents of the UAE who've been very active in these few months. They will just increase their activity. Off-plan would also stabilize and the summer ends. And when that happens, the pricing inefficiencies will shrink. The easiest deals will disappear, the discounts won't really happen as much. And also, not everyone is in distress. Don't just search for distressed properties, because there are many investors who hold very long term and they are not shaken by this kind of events. And that's exactly why we are acting right now. And again, I'm not telling you you should do that. If you want to or you were planning to invest, then probably this is a cool, interesting window to consider. But other than that, I'm just sharing our journey, and again, I hope you find it interesting and helpful. Also, I've recently introduced the channel memberships where we do very detailed breakdowns, so do check it out if you want to see all the details in the specific towers and specific details of those units. We'll cover the full financial modeling, not just the costs, acquisition assumptions, the return projections, not just for the first year, but also for the next 5 years, sensitivity scenarios and exit analysis, and also risk considerations, especially in most of this event happening at times. I put a lot of effort into making them really helpful and applicable to your own journey if you want to become a property investor, or if you're already one and just want to see what others are doing in the market. So please do check them out by the link in the description. Now, to close it all up, the market today feels very different from 6 months ago. People are more cautious, the conversations are or different, and the expectations are changing. And yet, that's exactly where we're still sourcing deals and adding up opportunities and units into the portfolio, just because I've seen more opportunities, more deals happening at much better prices right now than ever before. Not because the market is collapsing, not at all, but because fewer people are willing to act. We'll see what the next few months will bring. We never know, but we just look at the data, we do our due diligence, and act accordingly. And we're only 7 units in, more to go, and I'll share all those acquisition journey with you here on the channel. If you have any comments whatsoever, drop down your thoughts in the section below. I'll try to answer to all of you, and I really try to make this worthwhile for you, for your time being here, and I appreciate you watching today. And as always, bringing you the unbiased truth in real estate. Stay safe, and see you in the next one.